Hello young traders, Duane Shepherd here once again from DFX, Swing Trading Mentoring. Going to be taking a look at a trade that was made on my live account on the Aussie Canadian dollar to show you once again how we go about trading the major consolidation breakouts that take place on the daily chart and the 4-hour chart. Also going to be taking a look at the importance of exiting our trades at the major support and resistance areas of these larger time frames, because this will allow us to maximize on the trading gains provided by the market ahead of the sharp reversals that normally take place at these major pullback points. Now here you can see the summary of this trade, which was done on my live account with FX Pro, which provided a trading gain of 37 pips and a rate of return of 3.41%. Now in taking a look at this trade, also going to be addressing the 5 main factors and challenges that face us when it comes to trading the currency market. The correct way of drawing market setups, how to identify risky versus strong signals, weak versus strong stop loss areas, whether we should exit our trades at or before support and resistance areas, as well as the pip targets and the holding periods that we should establish for our trades. Once you're able to incorporate these 5 main factors and challenges successfully in your trading, you will be better able to identify market direction and maximize on the trading gains provided by the market ahead of sharp reversals. Now the trading platforms that I use for my trading are FXCM and FX Pro. I use FXCM because of the greater clarity of the charts and the fact that they actually, in my opinion, provide the best representation of the New York close of the daily candle, which is crucial to trading methodologies like mine that are based on candlestick formations. However, when it comes to my live trades, I actually prefer to use FX Pro for 2 main reasons. The first is that you can actually see the exact risk and reward values of the trade that you're about to make in percentage terms, which will ensure that you're able to stick within the risk reward parameters that you have established for your trading. And the second reason is that you can actually receive email alerts informing us when the trade has been completed, which will help to avoid the self-sabotaging behavior that normally arises when we monitor our trades. So to avoid the problems associated with that, I take advantage of the email alerts provided by this platform to ensure that I do not compromise my long-term profitability by being tempted to close trades too early. Nevertheless, once I see a successful or profitable trading setup, trading is done on both platforms, both the FXCM demo account that I use, as well as the live FX Pro account, to essentially show you that there's no difference between the results that you get on a demo account and a live account, so long as the methodology that you use is the same and that you follow the rules for this methodology at all times. Now here you can see the setup on the daily chart for the Aussie Canadian dollar, where basically what I had identified was that based on the nature of the bullish and the strong bearish waves that have been formed so far, it gave us the impression that the market was going to be forming a major consolidation setup. So we already had these 2 waves, and what was needed and projected was that the market would form another bullish and bearish wave that would complete the formation of a possible range consolidation setup. Now what I found with the currency market, and which you can see in a section in my trading manual, is that once you can spot certain types of bearish and bullish waves that take place consecutively, it is usually an indication that the market is about to form a consolidation setup. So once you're able to spot these early bullish and bearish waves, you can actually trade them until the consolidation has been completed, instead of waiting until the consolidation has been completed and then trading between resistance and support. So what this does is that it allows us to get early pip and trading gains until the consolidation has been completed. Because what you can find happening is that after consolidation has been completed, you may not get the type of risk to reward ratios that you would prefer when it comes to trading the consolidation that you're looking at. So to capture early trading gains, you can trade these early waves until the consolidation has been finally completed. Now what was also taking place within the context of that projected consolidation setup was that the market was also breaking out of this pennant setup that was formed between this resistance and support area here. So the breakout was taking place below support. And so what was going to be done was to take advantage of this bearish movement and trade it towards the support point. Now, going back to the trading manual once again, what you'll find with respect to consolidation breakouts is that you can find that the market will start these breakouts in one of three ways. Taking a closer look, the first way is for the market to actually start the breakout with a single bearish candle, if we're talking about a breakout from support, and that breakout will continue until the breakout finally ends at this area here. Second way in which the market can start these breakouts is for the market to head towards the boundary, temporarily pull back inside of the boundary, and then U-turn to break below the boundary and provide us with a breakout signal. And the third way, which is the one that took place on the Aussie Canadian dollar, is for the market to initially break the boundary, pull back to then test the broken boundary, and then U-turn to provide us with a breakout signal. Now, in terms of breakouts from consolidation, if we're talking about an aggressive moving consolidation breakout, then the most common signal that you will see that the market will provide us for entry is the one below here, referred to as a bearish engulfing candlestick formation. So you'll have several types of candlestick signals that take place in downtrends, but the most common ones that you will see when it comes to aggressive breakouts from consolidation, where the market is moving pretty quickly, are bearish engulfing candlestick formations. So this was a setup in terms of the consolidation breakout. As you can see here, the market broke out of the support boundary, below the support boundary initially, but then pulled back to test the broken support boundary before U-turning to continue the breakout bearish and break this counter trend line that was formed as part of this temporary pullback. Now, taking a closer look at the daily chart and the signal that was given as part of this breakout, here you can see that the market provided us with a bearish engulfing candlestick formation, which was a signal that was indicating that we could take advantage of this breakout and trade it towards the support area at 0.9104. So this was a trading target and the trading setup and the signal that we were going to be trading. Now, in terms of our stop loss placement, trend lines on the larger time frames on the daily chart and the 4-hour chart are normally very reliable in terms of being able to protect our trade. So once you're able to identify a downtrend and draw a strong downtrend line across the highs of resistance, then that trend line can be used to protect our trade until a trading target has been hit. You'll also find counter trend line setups are also useful in conjunction with downtrend lines, and these counter trend lines are basically the small trend lines that you can draw below the candles as the market temporarily reverses before resuming the downtrend. Now here you can see the situation on the 4-hour chart. That was going to be the time frame that will be used to protect our trade. So on the 4-hour chart, we were able to identify the areas of resistance and draw this downtrend line, and also identify this pullback area here, which allowed us to draw this counter trend line, which would also be used to protect our trade. So the stop loss was basically placed at the intersection of this downtrend line as well as this counter trend line. You'll also notice that there was a small pennant setup here that was also broken, and that the market also pulled back, initially broke out, pulled back, and then U-turn to continue the breakout from this consolidation, similar to what we saw on the daily time frame as well. So the stop loss was going to be placed at 0.9190, and what was done also was, instead of enter the market as soon as the candle closed at this 4-hour candle, which coincided with the close of the daily candle, the bearish engulfing candlestick formation on the daily chart, what I did was to wait until the market pulled back a little, which would have given me a better entry in keeping with the type of risk to reward ratio that I wanted from this trade. So I generally try to aim for a rate of return of between 3% and 4%. And so what I wanted was for the market to pull back at 0.9144. And as you can see here on the daily chart, the trading gain was captured as the market continued the bearish movement and provided us with a trading gain of 37 pips. And as you can see here in the 4-hour chart, the market did pull back a little bit and provide me with a better entry. And eventually the market, well, it didn't exactly move aggressively. You can see that the market did pull back after pulling back initially. The bearish movement continued with this bear candle, but then the market eventually moved sideways and slowed down a little bit. But because the support target was always going to be hit, it eventually was. And so it was really just a matter of waiting until the trading target was hit to provide us with this trading gain. So this was a trading gain, taking advantage of the bearish movement and trading towards the support target. And as you can also see here on my live account with FX Pro, you can also see the trade result here as I exited the trade at a support point. Now, very important when it comes to trading in the currency market is to ensure that we're able to exit our trades at the right area. And if we're able to identify a major support point when it comes to trading in the currency market, especially if these are on the daily chart, on the 4-hour chart, then it is very important to exit our trades at these areas because of the possibilities of major pullbacks. Now here you can see that shortly after or immediately after I exited the trade at the support area here, you can see that the market rallied sharply and eventually broke above this downtrend line on the 4-hour chart. So this is why it is very important to ensure that you're able to identify these major pullback points, because you can find a situation in which the market can reverse sharply and take away your trading gains. So if you're trading on a smaller time frames, for example, you may have been in a profitable trade trading this bearish movement, but if you are not aware of these major pullback points on the larger time frames, then these sharp reversals can take place and they can appear to come out of nowhere and can lead to unexpected and sharp reversals. So that's why it's very important to stay on the larger time frames where we'll be better able to identify these major pullback points, which can lead to sharp and aggressive reversals that can take away our trading gains. So in terms of the 5 factors and the challenges that will allow us to successfully trade the currency market, we identified the setup that was being traded, which was essentially the formation of a consolidation setup, as well as a breakout from a small pennant setup that was taking place as well on the daily chart. Now in terms of the risky versus the strong signals, since we were breaking out of a consolidation setup and the movement was pretty aggressively, was pretty fast, then in most cases the signal that we would trade and look for is a bearish engulfing candlestick formation, which was the one that actually worked out and provided us with a trading gain. Because what you can find happening is that even if you correctly identify the trading direction of the market, if the nature of the movement and the candles as part of that trend, if the signal that you're trading is not in sync with the movement, with the candles that have been taking place so far on that trend, then you can actually find yourself entering the market with the wrong trading signal and find yourself being stopped out. So if the market is breaking out in terms of fast and aggressive candlestick formations, then those are the ones that we would trade to take advantage of that movement. Strong versus weak stop loss areas. Since we're trading on the larger time frames, stop losses that are provided by downtrend lines are generally more reliable and will better protect our trades until our trading target has been hit, compared to the trend lines that you'll see on the smaller time frames, which are a lot weaker and which can be easily broken as a result of these temporary pullbacks. So to ensure that we're able to withstand these temporary pullbacks until our trading targets have been hit, the best areas to place our trades are trend lines that have been formed on the larger time frames, which are much stronger and thus much more reliable in terms of protecting our trade. Whether we should exit at or before support and resistance areas. Since the market was breaking out of a consolidation setup, which normally moves fast and aggressively, then it usually means that it has a lot of momentum and sufficient momentum to carry us towards major support and resistance areas that are formed nearby. So it's usually a good decision to be able to exit our trades at that area and capture a strong trading gain. You definitely do not want to exit your trades beyond these areas because of the greater likelihood of a strong pullback, especially when these support and resistance areas are on the large time frames. And finally, in terms of pip targets and holding periods, I generally target trading gains of between 50 pips and 70 pips, as you will see on my Instagram page where I describe my methodology. But where justified, if the setup is strong enough and the distance is fairly strong enough, the distance is fairly wide enough, that will allow me to capture a trading gain of between 3% and a 4% rate of return, then I would also justify trading gains of less than 50 pips, such as this trading gain here of 37 pips. And the holding period that I normally use for my trades is a maximum of 24 hours, because this is the time period that I've noticed that the market will normally take to provide us with trading gains of between 50 pips and 70 pips. And holding out for a longer period than that normally causes us problems, as the market normally slows down and increases the likelihood of a reversal that can take away our trading gains. So that's it in terms of this trade that was done on the Aussie Canadian dollar. Basically showing you how we go about trading consolidation breakouts that take place on the larger time frames of the daily chart and the forward chart, and how we can take advantage of it and maximize on the trading gains provided by these setups by exiting at support and resistance areas before the market reverses and it takes away our trading gains. So if you have any questions, you can let me know by emailing me at shepherdduane@gmail.com. You can also find me on Facebook and Baby Pips using the same username, DRFX Trading, Twitter at Worldwide876. You can also check out my blog, drfxtrading.blogspot.com, where you can find a history of my trading results and analysis, as well as on my Instagram page at drfxtradingboss, where you can find further explanations of the methodology that I use. So until next time, traders, all the best and happy trading.